In today's video, we're going to go over a topic I've been thinking about since my video on rare earth mining materials, a country with a rich history, culture, and prospect for global growth. Hey everybody, welcome back to Dollars and Cents, helping you make sense of making dollars. Remember, if you enjoy the informational investing content on this channel, to like and subscribe. Also, be sure to check out the link in the description to join my Discord so you can hang out with me and some other cool people from this community. With that, let's get right into it. If the flag didn't give it away, we're talking about Japan, the land of the rising sun. But before we get into why I think Japan might be a great investment, I think we need to set the stage and first talk a little about Japan's more recent history in global markets. You might have heard this term before, cross-shareholder ownership. This is when a public company holds the stock of another public company. For example, Berkshire Hathaway owns around 887 million shares of Apple, or about 5.3% of the company. By itself, cross-shareholding isn't necessarily a bad thing, but it's an old corporatist way of doing things, and it's not really good for a free, competitive market. This graph shows a shift away from cross-shareholder ownership and shows it's actually been decreasing in Japan since 1990, indicating a turn for a more competitive market in the country. In more recent times, most of this has been because of Hiromichi Mizuno, appointed by Japan's Prime Minister Shinzo Abe in 2015. Mizuno assumed control of Japan's largest nationwide pension fund, the GPIF. Interestingly, Mizuno was, by all classifications, an outsider, having been previously a partner at the London-based private equity fund, Collar Capital. He went after Japanese companies, demanding the reasons why they weren't raising dividends and why they were stockpiling cash. He also incentivized them by promoting ESG practices with green bonds. With these policies and incentives, Mizuno brought Japan out of a corporate-centric market and implemented the policies that saw these companies start to return capital to their shareholders. Now, Japan's market is intensely competitive, where buybacks and dividend raises are commonplace. With that covered, let's jump to 2021 and the possible future for Japan's growth in the global market. Like it or not, Japan's current economy is linked heavily to China. We're not going to get into China or all that entails, but the numbers show that China's had one of the strongest recoveries from the COVID-19 pandemic. In fact, China grew its GDP by 6.5%, making it the only developed nation to post positive GDP growth in a year wrecked by a pandemic. 19.5% of Japan's exports are to China, with most of Japan's capital goods in the industrial sector being exports to China. Around 40% of the earnings from the sector come from Chinese orders. As the world starts to reopen and recover from the government lockdowns, international trading will fire up again, and China's going to need Japan's industrial goods more than ever. The relationship is, for the most part, going to remain strong. Cars are actually Japan's second major export after goods in the industrial sector. For decades, companies like Toyota, Mitsubishi, and Subaru have dominated the car industry. With the rising push to move into green technology and electric vehicles, these Japanese car makers certainly have the resources to hop on the trend. Toyota's already started with the Prius, and even Nissan has the Nissan Leaf. With a decade plus of experience already in the electrical vehicle manufacturing market, Japanese car companies could expand even further. Fundamentally, Japan is an investment in global growth. We've already seen promising results in that, despite the year and a half of losses, more Japanese companies are beating earnings in their quarterly earnings reports. We know much of that has been fueled by Chinese demand, but nevertheless, this is a great indicator for the Japanese market. The country's market has grown right in line with global GDP and has been since the 1990s. Even Berkshire Hathaway CEO Warren Buffett sees the promise in Japan's global potential. Back in September, Buffett's forays into the country's market came to light, and I didn't really think too much of it, but it got me thinking why. So I decided to do a little digging and find out why, and I think I agree with the fundamental reasons for Buffett's interest in the Japanese trading houses. When I looked around for myself, I got the idea that a lot of these Japanese companies seem, let's say, discounted. For example, Mitsui Corporation's charts indicate that over the last 12 years, its stock has steadily traded around the $15 to $19 range. In fact, many Japanese companies have similar prices. They consistently trade in a very limited range, not really increasing over the years. It could be that Buffett also thinks these companies are undervalued and wants to ride the wave of growth in these Japanese companies, many of which are tied to the global growth of the world economy. Again, Japan is just starting to reach new heights after years of almost no growth. In other videos, we've talked about diversity in an investment portfolio, but we need to include international diversity in the portfolio too. In the field of investing, there's a lot of discussion on the ideal portfolio in terms of how much should be allocated where. In the US, in Japan, well, let's take a look at this. We see here that there's a 70% allocation to US-based stocks, 20% allocation to international stocks, and 10% allocation to bonds. This is, I think, an ideal portfolio for normal times. As we start to come out of this pandemic and we return to normalcy, I plan to adjust my own portfolio to more accurately fit this model, especially including Japan because of all the indicators for incredible potential growth as the world reopens again. And I will say this, currently my own portfolio doesn't have much to do with bonds as I don't think they're a really optimal investment right now, but that's a topic for a different video. If anything, I want to focus on international diversity before going back into bonds. International diversity is extremely important in any portfolio because investing as a whole is somewhat unpredictable. You definitely want to hedge your bet in a sense and not go gung-ho into one market, for example, not all in the US stock market. You can't reliably predict where the US markets will go, and as much as I might not like talking about indicators, I do think that the CAPE ratio is certainly worth a mention. The cyclically adjusted PE ratio, also known as the Shiller PE ratio, is the inflation-adjusted earnings of companies over the last 10 years. This has been creeping up since 2010 in the US and is reaching concerning levels, because historically, these levels in the CAPE ratio indicate an incoming market slump. Now, I'm not going to say that there's a market crash coming in the US and we need to start hoarding gold or something. I just think that it's important that as investors we recognize that these good times cannot continue forever. Look at Japan, it's finally coming out of an economic slump. It's got the potential to grow, whereas the US market has the potential to stagnate. This is why I believe the international allocation, diversity, and exposure is important in a portfolio. You can't just have complete reliance on your home country's stock market. When things start slowing down and the market trades sideways for the next few years, you'll have missed out on some potential growth if you had invested in foreign markets. With all that information, how would you even get started to invest internationally? Let's say, for example, in Japan? Well, one way I'm trying to capture the essence of Japanese growth in the world economy is through DXJ, which is possibly the best ETF to explore the core Japanese stock market. DXJ is a dividend-weighted portfolio of Japanese stocks that derive less than 80% of the revenue from Japan. It is also currency hedged. We won't get into the complexities of this, but just know that it's essentially a safety measure in trading to protect against the value of Japanese currency going down. DXJ is primarily weighted toward the industrials and consumer cyclical sectors. Its largest holdings are companies like Toyota, Mitsubishi, and Sumitomo Mitsui. These are primarily the mega-cap Japanese companies that have been around for a really long time. On the other hand, we have DXJS, which is a fund that focuses on primarily small-cap Japanese stocks. It is also heavily weighted towards the industrials and consumer cyclical sectors of Japan. The fund holds companies that are even harder to pronounce, like the J-Tech Corp, Sojitz, and Mebuki Financial Group. Overall, I think these are the best funds to buy and hold, first for the dividend and second for the currency hedging to mitigate the risk of losing money on exchange rates. I also believe the largest holdings of these funds are great companies that will grow greatly as the world economy grows. They are great ways to start investing internationally. Coming off of a 30-year slump, Japan is positioned to be a tremendous opportunity that even Warren Buffett believes is valuable. Through the hard work of Prime Minister Shinzo Abe and Hiromichi Mizuno, the old bureaucratic, corporatist way of doing business in Japan is gone, making way for the Japanese economy to blast forward in the global economy and a great opportunity to start investing internationally. As the land of the rising sun continues its excellent streak of growth, I look forward to investing in Japan in the dawn of a new era. With that, I hope you all enjoyed, and I hope to see all of you in the next episode of Dollars and Cents.